Welcome to Trade Ideas. I'm Jake Merl, sitting down with Jannarone, Editor-in-Chief of IPO Edge. John, great to have you back on the show.
Thanks, Jake.
So I usually don't really say this at all to our guests, but your past few trades on our show absolutely crushed it. I mean, you were just here about a month or so ago, and I don't mean to cherry pick because we do review both the winners and the losers, but I mean, you really do deserve a little victory lap here.
Thank you.
You were last here about 6 weeks ago in April discussing the bear case for Lyft. You said the stock would drop to $50 a share due to overvaluation, insurance issues, the employee-contractor situation, and a whole host of other different reasons. The stock dropped like a stone immediately after your interview and hit your target. Can you please briefly review your bear thesis on Lyft and why you recommended going short?
Sure, Jake. So I think that the biggest argument against Lyft was the fact that these rides are a commodity and the margins are very, very narrow. And as a result of that, the odds of them making money anytime soon are super slim. I mean, if you recall, I was talking about even the bullish analysts expecting EBITDA to go positive only maybe 2023 or so. It's just hard to pay 5 or 6 times sales for that. But the other piece of it that I did discuss, you mentioned, is the insurance liability. These guys carry so much of that on their books, and it's really hard to analyze that. I mean, we're trying to talk about a tech company here, not an insurance company. So I thought that was a little bit puzzling and another reason to give pause.
But why did the drop happen so quickly? I mean, even you weren't expecting to happen
Right.
so quickly.
No, I wasn't. I mean, I was thinking that was more of a year-end target. To be honest, I think something technical may have gone on. So I've since looked into that, and you know, as we all know, shortly after Lyft went public, Uber came on, and there's a good possibility that a lot of those Uber shareholders who are not allowed to sell their stock or hedge by law were looking for creative ways to do it. And what we saw was the percentage of shares outstanding, or the float that was borrowed, shot up to over 60% in Lyft. And the explanation for that could be that there are a lot of Uber investors, perhaps employees, who shorted Lyft very, very aggressively in place of getting out of their Uber stock. And to this day, the percentage of float that's borrowed is nearly 70%.
And so is that speculative at all, John? Or do you actually know for a fact that, you know, the Uber shareholders went out and shorted Lyft?
No, I mean, it is speculation, but I think it really stands to reason. I mean, I was looking into all kinds of things that were going on with Uber. Another thing that was interesting is that there were plenty of shareholders who couldn't sell in the IPO itself, but were trying to sell in the secondary market right around the same time. So we all talked about 11% of the shares being sold in the IPO, but by some estimates, it was more like a quarter of the outstanding stock that was available if you include the secondary market. So given that, I think, you know, if you start to connect the dots, it makes sense that a lot of that short selling in Lyft, even if you don't like the company, for it to be sold that aggressively when the borrow is that expensive, I mean, we're talking about 30% plus annually, it all points to Uber.
So given the massive increase in the short interest, would you still be looking to go short Lyft here, or would you be taking profits on your trade?
Well, I still think if you go back to my original thesis, which was based as much as I could on fundamentals, I mean, even though this company doesn't have any profits, you know, if you look at a reasonable sales multiple, I said $50. We got here fast. I think it's probably time to take your money off the table. I mean, I think the real cash has already been made. Now, another thing that, you know, you got to wonder about here is, could there be a short squeeze? And that gets back to this whole issue of those Uber shareholders. My bet is that if they see the stock start to creep up and it looks like there's going to be a squeeze, they're not going to run away from this thing like you might see a lot of short sellers would. So I would say that any squeeze might be mollified by that.
So you actually recommend just staying away from the stock right now?
Yeah, I mean, I hate to recommend a hold here, but I mean, I think it's okay to take profits.
So shifting gears to the second trade you had last time, you had a bullish bet on this particular SPAC, Thunderbridge, and you recommended playing it through the warrants. You suggested buying them around 80 cents or so, and they actually doubled to over $1.60 just within a few weeks from your interview. Can you please briefly review what a SPAC actually is and then your main thesis on Thunderbridge?
Yeah, definitely. So a SPAC is a special purpose acquisition company. In this case, what the company did was raise cash, identified a target, and it happened to be this company called Repay. And what they do, it's a fintech company, so they make it a lot easier to repay auto loans, personal loans, stuff like that. So every time these are issued, they have these warrants attached, and that's an incentive for hedge funds and other investors to buy the SPAC before they know what the target is. It's obviously a risky thing because the warrants can expire worthless. They're far out of the money. But what happened here was that these guys found some other investors, some very prominent investors, in fact, Neuberger Berman, Barron's a big long only fund, and they came in before the deal was actually closed, and the guys got together and said, we don't want this dilution from these warrants, so let's call them. So this is something that was pretty much unheard of, and I would never have expected this to happen so soon, but it did. So effectively what happened is all those warrants are going to be taken out for $1.50 in cash plus a quarter of a warrant. So they're not exactly called, it's a variation on it. So since the private placement was announced, I actually think that this has become a more attractive opportunity. Here's why. They're going to be called for $1.50 in cash, plus you get to keep 1/4 warrant per previous warrant. So the math that you would do there is you subtract out the $1.50 from the $1.65, and that's 15 cents. So if it's a quarter warrant for 15 cents, you would multiply it by 4 to make an estimate of what the valuation would be for a whole share. So that's about 60 cents. Now, like you said, before this happened, they were trading at 80 cents. So what I see here is an opportunity to own the warrant piece for less than it was before this deal was announced. But clearly the situation's gotten more attractive. You've got Neuberger, you've got Barron, and they just reported a good quarter. They announced a very experienced director who's going on the board, who is on the board of MasterCard. So if I were in this, I would absolutely hang on. I mean, it looks hard to do. I mean, it's very tempting to take profits after a 115% jump or something like that. But believe it or not, I think the situation's even more attractive.
So just to break that down a little bit more, you're actually saying that even though the warrant doubled in price, it's actually cheaper than it was last time.
Well,
right?
yeah. So the idea is that $1.50 of that $1.65 is just cash. It can't move. I mean, it would be ridiculous for it to trade any less than that. I mean, there is a possibility the deal doesn't happen, but that looks extremely unlikely now that you've got these other investors coming in. So I would say if you put a near 100% probability in the deal happening, you got $1.50 there. The remaining 15 cents is what the warrant's worth. And if you go back to before the deal, the warrant was trading at the equivalent of 80 cents. But multiply the 15 by 4, it's like 60 cents. So I know there are a lot of moving pieces here, but I think that what might be happening is that there are people who made a lot of money in the warrants and are taking profit. But it could be an opportunity if you look at it more carefully.
So how much more upside do you actually see for the warrants?
Well, I think that this is initially I said that they could double, and I think that now that could happen over time. But I think what I was thinking then was 80 cents and another 80 cents upside. So let's say there's another 80 cents upside in the next couple of years.
So would you recommend new traders get involved with this position now, or are you just recommending holding on if you already had a position?
I think either way. I mean, what I believe is happening is that there are some people who are trying to not be greedy because they see that they just got a home run, right? They got taken out. It's probably a bunch of hedge funds who bought this in the IPO, and they want to sell a winner. And I would absolutely think this is a good place to get in as a new investment. If you want exposure to that, I mean, remember it's not that liquid compared to the stock. But if you want to take a new position, I think it's really interesting.
And so what's the catalyst to get it there? What fundamentals are you looking at? What's the valuation? What are you most interested in?
Well, these guys are growing EBITDA at about 20%, which is way faster than most of their peers. I mean, Square's growing faster, but Square trades at 50 times earnings or something. So you can get this for about 12 times 2020 EBITDA. And I think that if these guys just post a few good quarters in a row, the stock's going to grind up. It's not like something revolutionary has to happen. I mean, it's not that complicated of a business, but it's strong. And I don't think it's that sensitive to the economic downturn either.
And over what time horizon do you expect this to play out? The 80-cent target.
I'd say let's say 2 years. I mean, I've had things happen quicker than I expected recently here, so give me a little time.
And what would you say is the biggest risk to this trade?
I mean, the biggest risk, and as I said, I think there's a very, very slim chance of this happening, is that the deal does not close. Remember, that has to happen for this to turn into actual shares of Repay and Repay warrants. In the meantime, I think it's competition. But I think, as we discussed in the last interview, I believe I got into the fact that there are big players out there in this space, and if one of them made a really, really big push into this same area, they could take business away from them. But I think that it's a strong enough brand, and they've got I think the customer relationships are so sticky that I don't see that as a huge risk. But that's probably the number one in my mind.
Well, John, that was great. Thanks so much for joining us.
Thanks, Jake.
So John likes taking profits on his short Lyft trade. He also recommends holding onto or buying the warrants for Thunderbridge acquisition at current levels. He sees 80 cents of upside over the next 2 years. That was John Jannarone, Editor-in-Chief of IPO Edge. And for Real Vision, I'm Jake Merl.